Welcome to the Byte-Size Brief. Today we are putting Dakota Gold, DC, as DC, completely under the microscope. Let's get into it. So, I want you to imagine for a second that you are staring at this overgrown, totally empty lot.
Okay.
But, this isn't just any lot. It happens to be sitting directly next door to a sprawling, multi-million-dollar Beverly Hills mega mansion.
Right. Nice neighborhood.
Exactly. You look around, you see the neighborhood has world-class plumbing, this immaculate power grid, and property values that are just absolutely astronomical.
Yeah.
But the only question is, what happens when you actually start digging your own foundation?
You mean, do you hit solid bedrock to build on, or do you hit a financial sinkhole?
Spot on. Do you build an empire or lose your shirt?
Well, that's the exact scenario currently playing out in the historic Homestake District of South Dakota.
It really is. And for those of you actively tracking the markets, you know exactly why we're looking at this deep dive today. I mean, we're taking a snapshot of a company trading right around $5.25 a share.
Which gives them a market cap of roughly $700 million.
Right, $700 million. But what is truly staggering here, I mean, just wild, is the incredible 12-month run this stock has had.
It's been aggressive, yeah.
Massive. We are talking about a rally from a 52-week low of just $2.40, rocketing all the way up to a high of $7.25 earlier in 2026.
Yeah, that's a serious move.
It makes every retail investor sit up and take notice, right? You wonder, have I already missed the boat, or is this rocket ship just refueling on the launch pad?
I mean, it is certainly an eye-catching chart, but we really need to step back and ground this discussion in the operational reality.
Always the voice of reason.
Well, someone has to be.
Okay.
Look, Dakota Gold, trading under the ticker DC, is a pre-revenue exploration company. They do not currently pull a single ounce of gold out of the ground to sell.
Zero product.
Zero. They have no product. Their entire operation right now is completely focused on the exploration and development of, well, really two primary assets, the Richmond Hill and Maitland projects. Right. So our mission for you, the listener, is critical today. We are stripping away the whole gold rush hype.
Which is everywhere right now.
It is. We need to figure out if the underlying geological data, the physical drill results, and their aggressive financial maneuvering actually support a near $700 million valuation for a company that isn't making a dime.
That is the literally $700 million question.
Yeah.
And I think to understand if that valuation makes any sense at all, we first have to understand where the gold is actually located in the ground.
Because geography dictates the business model.
Exactly. In mining, geology is destiny, sure, but geography is your business model. And the Homestake District is absolutely legendary. I mean, historically, this specific area has produced over 40 million ounces of gold.
It's one of the most prolific districts in North America.
Oh, yeah. And when you look at the broader macro narrative right now, gold prices are just surging. Central banks around the world are aggressively buying up sovereign reserves.
Right.
And so historical mining companies globally are suddenly seeing their dormant claims become incredibly valuable as the whole macro sector catches fire.
Right. But what does all that actually mean for Dakota Gold DC investors?
Okay, fair point. Fair point. Let's bring it back to the specific dirt that DC actually owns.
Yeah.
Because having great neighbors doesn't automatically put gold into your own ground.
Precisely. And the real value driver for investors here isn't just the history of the district. It's actually the legal and regulatory status of the land itself.
The paperwork.
Exactly, the paperwork. Dakota Gold operates primarily on private land, and I really cannot overstate how massive of a structural advantage this is in the North American mining industry.
How come?
Well, when a company operates on federal land in the United States, say land controlled by the Bureau of Land Management or the Forest Service, they trigger the National Environmental Policy Act, or NEPA. Yes. That requires a sprawling environmental impact statement. I mean, it is a sluggish, highly bureaucratic federal permitting process that can easily stall a project for, 7 to 10 years before a single shovel even hits the dirt.
Just drowning in red tape and endless public comment periods.
Exactly. But because Dakota Gold, DC, is operating on private land, they bypass that federal NEPA bottleneck entirely.
Wow. Entirely?
Entirely. They only require state and county permits, so that shaves literally years off their development timeline.
That's a huge advantage.
It is. Furthermore, if we want to understand the physical potential of this specific location, we just have to look at the benchmark right next door.
You mean the Wharf Mine?
Right. Core Mining currently operates the Wharf Mine, which is a highly successful heap leach gold operation located just 3 kilometers south of DC's Richmond Hill project.
3 kilometers is nothing.
It's right there. They are essentially sharing the exact same infrastructure corridors.
Okay, so going back to my opening scenario, it really is like buying that empty lot next to the Beverly Hills mansion. I mean, the heavy lifting of building the neighborhood is already done, right?
Essentially, yes.
Like there's a power line running right through the Richmond Hill property. There are established haul roads.
Right.
They don't have to build some remote, wildly expensive mining camp out in the wilderness because, well, their workforce can literally just commute from nearby towns like Lead or Deadwood.
Exactly. And that drastically reduces the initial capital expenditures required to get a mine up and running.
Which is the hardest part.
It is. That is the exact fundamental bull case here. The infrastructure is in place, but, the burden of proof is still entirely on what is actually underneath that lot.
Right, the dirt. So let's look at the actual dirt.
Yeah.
What exactly is Dakota Gold, DC, digging up right now to justify building a multi-million-dollar mine?
Well, they have been incredibly aggressive with the drill bit. In 2025, they executed this massive drill campaign, completing 242 holes.
242. That's a lot of drilling.
It's a huge program. And what we are looking for in these results is not just the presence of gold, but the grade, meaning, how much gold is actually in a ton of rock, and the width of that mineralization.
Okay, and what did they find?
They reported some very high-grade hits at the Richmond Hill expansion area. Specifically, they highlighted a recent intercept of 3.14 grams per ton of gold, or GT, and 10.57 gram of silver over a 13.4-meter span.
That's a solid chunk of rock.
It is, and even more striking, they hit a massive 17.35 gram of gold over a 1.5-meter interval.
Okay, I want to pause on those numbers for a second because we need to explain to the listener why that is so significant. Kerr's Wharf Mine next door is a heap leach operation.
Correct.
And for anyone unfamiliar, heap leaching is basically a giant, highly engineered chemistry set.
Yeah.
You take low-grade ore, you crush it up, pile it onto a massive impermeable plastic pad, and slowly drip a weak cyanide solution over the top.
Right, gravity does the work.
Exactly. As the liquid seeps down through the rock, it chemically dissolves the gold, and you collect that gold-rich solution at the bottom.
It's very efficient.
Super efficient, because you don't have to build a massive, wildly expensive milling facility to grind the rock into fine powder. The operating costs are incredibly low.
That is the exact mechanism. And because heap leaching is so cheap to operate, grades as low as 0.5 grams per ton can often be highly profitable.
Half a gram.
Right. So when Dakota Gold, DC, is hitting over 3 grams per ton, let alone 17 grams per ton in certain structural zones, it completely changes the math.
I'll say.
Injecting that kind of high-grade ore into a low-cost heap leach operation provides incredible margin flexibility. It means the mine can remain highly profitable even if the broader macro price of gold suddenly drops.
But I mean, a drill hole is still just a hole in the ground, right? They are pulling up rock cores, not cash.
True.
So what is the actual timeline to turn those high-grade hits into a functioning, cash-flowing heap leach pad?
Well, the timeline is exactly what makes 2026 such a pivotal year for this company. They are currently executing a 15,481-meter drill program.
Which is happening right now.
Right now. And this isn't just exploratory drilling, it is tightly spaced infill drilling, specifically designed to feed into a pre-feasibility study, or PFS.
Okay.
And that PFS is slated for release in the second half of 2026. A PFS is a critical milestone.
How so?
It is a highly detailed engineering and economic document. It defines the initial capital costs, the operating costs, the metallurgical recoveries, and the actual mine sequence.
Basically the blueprint.
Exactly. And following that PFS, they aim to deliver a full feasibility study in the first half of 2027, with the ultimate goal of reaching full commercial production by 2029.
Hold on, how does that actually affect Dakota Gold DC's stock price for regular investors like me? I mean, commercial production in 2029 is still years away. Why should the market care about a pre-feasibility engineering document being released in late 2026?
To understand the market mechanics here, you really have to understand the Lassonde curve.
The Lassonde curve.
Right. The Lassonde curve is the foundational life cycle chart of a mining stock. It almost always follows a very specific pattern.
What?
It starts with a massive euphoric spike in the stock price during the initial discovery phase. That is fueled entirely by speculation and flashy drill holes.
Kind of similar to the run DC had from 240 to over $7.
Exactly, right. Everyone gets gold fever.
Oh, totally.
Precisely. But then reality sets in. The company enters what is universally known in the industry as the Valley of Death.
The Valley of Death. Sounds lovely.
It's brutal. This is multi-year phase where the exciting discovery drilling stops and the incredibly boring, highly expensive engineering and permitting work begins.
Right.
Retail investors get bored, the news flow slows down, the company is out there burning millions of dollars on metallurgical column tests and environmental baseline studies.
And the stock price tanks.
As a result, the stock price usually slumps heavily, yes.
Because nobody wants to hold a stock that is just quietly bleeding cash to pay independent engineering firms.
Exactly. However, the Lassonde curve also shows us the way out of the Valley of Death.
Which is?
When a company successfully delivers a robust pre-feasibility study, they transition from discovery into pre-production.
Okay.
The PFS converts speculative geological resources into official, economically viable reserves. When that happens, the risk profile drops dramatically.
And that's when the big boys show up.
Exactly. Institutional money, the big mutual funds and mining ETFs, begins to aggressively flow back in. This almost always triggers a massive valuation re-rating.
Got it.
So the late 2026 PFS isn't just a technical update. It is the specific catalyst designed to catapult the stock out of the Valley of Death.
Okay, so compared to last quarter, what actually moved the needle here? If the PFS is the catalyst that gets the big institutional money off the sidelines, how is the company paying for all this drilling and engineering to get there? And, how has Wall Street reacted to the operational progress over the last 3 months?
Well, we have seen a very measurable shift in institutional sentiment in the first quarter of 2026.
Positive or negative?
Very positive. On February 24th, Scotiabank initiated coverage on DC with a sector outperform rating and a $10 price target.
$10?
Yes. And shortly after, on March 3rd, BMO Capital raised its target on the stock to $9, also maintaining an outperform rating.
Wow.
If you look at the consensus right now, the median analyst target sits between $9.48 and $10 flat. Based on the current trading price, that implies a potential upside of roughly 80 to 90%.
I mean, an 80% implied upside from major institutional banks is a massive vote of confidence.
It is.
But as you mentioned, they are pre-revenue. Operating a fleet of drill rigs isn't cheap. You're paying for diesel fuel, highly specialized labor, expensive third-party assay labs to test the core samples, and environmental consultants.
It burns cash fast.
Exactly. How are they keeping the lights on to hit that $10 target?
They recently secured the capital to guarantee that timeline. On February 9, 2026, Dakota Gold, DC, announced and priced a massive $75 million public offering.
$75 million.
Yes. They issued over 12.3 million new shares of common stock. Alongside that, they received a $6 million first tranche financing from Orion Mine Finance.
That's a lot of cash.
This is a formidable war chest. It gives them the uninterrupted financial runway they need to comfortably execute the remainder of the 2026 drill program and fully fund that crucial pre-feasibility study.
And there's a major detail about that $75 million raise that completely changes the narrative for me.
Oh.
Yeah. They raised that massive amount of capital entirely without attaching warrants.
Right. That is significant.
In the microcap and junior mining space, when a company is desperate for cash, they usually have to attach warrants to the stock offering just to entice buyers.
It's very common.
Right. It's a built-in mechanism that eventually caps the stock price and dilutes the everyday shareholder even further down the road. The fact that the institutional demand for DC was so rabid that management could raise $75 million plain without handing out any of those sweeteners shows immense leverage. I mean, they didn't have to mortgage their future upside just to get cash today.
It is certainly a strong signal of institutional appetite in the current macro environment. However, as an analyst, I have to look at the dark side of the balance sheet.
Uh-oh. Here comes the reality check.
Always. Look, raising $75 million bolsters the corporate treasury, but we must objectively examine the true mathematical cost of that cash to the everyday shareholder.
Okay, let's hear it.
Let's look at the hard financial data. Dakota Gold, DC, generated exactly $0 in revenue last year.
Zip.
Meanwhile, they burned through a staggering negative $31.48 million in operating cash flow in fiscal year 2024 alone.
Wow. $31 million in burn.
To survive a burn rate that aggressive, their only mechanism is to issue equity.
Which means constantly printing new shares.
Exactly. If we look at the historical data, total common shares outstanding surged from 23 million in fiscal year 2021 to over 91 million in fiscal year 2024.
That's a massive jump.
And that 91 million figure is before adding the recent 12.3 million share offering we just discussed. They are rapidly approaching or exceeding 103 million shares outstanding.
See, that is the silent killer of equity value right there. Just doing the math. If you were an early believer and bought a 1% stake in the company when there were only 23 million shares,
Okay.
and suddenly the company balloons to over 100 million shares, your 1% ownership has been mathematically crushed down to a fraction of a percent.
Unless you constantly participated in every financing.
Exactly, unless you constantly poured more money into every new offering.
Yeah.
The overall company might be worth more, but your personal slice of the pie got razor thin.
It is classic aggressive dilution, and it's not just the share count expansion that is flashing warning signs.
There's more.
It's the internal flows of the stock itself. Late last year, CEO Robert Quartermain sold 250,000 shares at $6.88.
Mm-hmm.
Furthermore, major institutional holder Vestcor Inc. completely slashed its stake, reducing its position by 57.1%.
Wait, really? More than half their position?
Yes. When the CEO is selling hundreds of thousands of shares and a major institutional backer is simultaneously dumping more than half of their position right before the company enters the Lassonde Curve's Valley of Death, you have to ask questions.
Yeah, that's a pretty massive red flag, you know?
Are they signaling a lack of confidence in the upcoming PFS, or did they simply refuse to stick around for the mathematical dilution required to fund the 2026 drill program?
I hear the bearishness, I do, but let me push back on that for a second.
Go ahead.
I look at this exact same financial profile and see something more akin to building a massive, capital-intensive infrastructure project, like a deep-water oil rig or a skyscraper. You have to take on insane upfront capital costs and dilute your initial equity pool heavily just to build the foundation. The capital intensity is brutal.
It is.
But the point is, once the skyscraper is built and the tenants start paying rent, or in this case, when commercial gold production hits in 2029, the sheer volume of cash flow generated by a low-cost heap leach mine completely dwarfs the initial pain of the dilution.
Assuming it gets built.
Right. But basically, it's kind of like taking out massive student loans to pay for medical school. Yes, you are drowning in debt and dilution now, but if you graduate and become a brain surgeon, the future cash flow makes it all worth it.
That is the idealized outcome, yes. But unlike medical school or a skyscraper, the geological foundation here isn't guaranteed until the engineering actually proves it.
Fair.
And I must warn anyone looking at this stock, at a roughly $700 million market cap, accompanied by a negative 26.17% return on invested capital, the broader market has already priced in an assumption of flawless execution.
Price for perfection.
Exactly. The market is valuing Dakota Gold DC right now as if the 2026 pre-feasibility study is going to be perfect, the local permits are going to be granted without friction, and the mine will open exactly on schedule in 2029.
No room for error.
None. Any delay, any metallurgical hiccup in the PFS, or any unforeseen capital cost increase will severely punish the stock. When perfection is priced into a pre-revenue asset, disappointment is heavily penalized.
That is the ultimate tension here. I mean, the geography is spectacular. The regulatory jurisdiction is incredibly friendly because it bypasses that federal NEPA permitting, and they are fully funded to execute.
But the clock is ticking.
Loudly. The clock is loudly ticking, the share count has exploded, and Wall Street is holding them to an absolute standard of perfection.
Precisely.
But as we wrap up today's deep dive, I want to pivot. Summing up this intense risk versus reward scenario, what is the ultimate blue sky wildcard? Because there's a completely different side to this property we barely touched on that could change the math entirely.
Yes. You are referring to the Maitland project.
I am.
It is truly the defining wild card in the DC portfolio. While almost all of the market's immediate attention and that current $700 million valuation is intensely focused on the Richmond Hill heap leach timeline, Maitland represents a completely different geological beast.
It's right next door, though, right?
It is. It's located just a couple of kilometers east of Richmond Hill, but it hosts what is called the JB Gold Zone.
Okay.
This is a much deeper underground target.
And physically, what makes the JB Gold Zone so distinct from the rock they are drilling at Richmond Hill?
It features historic Homestake-style banded iron formations.
Banded iron.
Yes. And to understand why that matters, you have to look at the chemistry of the rock. Banded iron formations are ancient sedimentary seafloor layers that are incredibly rich in iron.
Okay.
When superheated gold-bearing hydrothermal fluids pushed through the Earth's crust millions of years ago and hit these iron layers, the iron acted like a massive chemical sponge.
Well,
It caused the gold to precipitate out of the fluid and concentrate in the rock at exceptionally high grades. This is the exact same geological mechanism that made the original Homestake mine a 40 million ounce behemoth.
so it's not just like sprinkling gold dust across a wide area. It's densely packing it into these iron traps.
Exactly. And the recent drilling Dakota Gold, DC, has done into the JB Gold Zone has proven this concept. They yielded an incredibly high average grade of 10.76 grams per ton of gold over 4-meter widths.
10.76.
Yes. That is underground, high-grade, Tier 1 style mineralization. It requires entirely different mining techniques than the bulk tonnage surface leaching planned at Richmond Hill, but the profit margins per ton of rock are staggering.
Which leads to a fascinating, provocative thought for everyone listening right now.
Which is?
If this 2026 infill drill program hits a massive maiden resource at the Maitland project, proving that this isn't just an isolated high-grade pocket, but a true structural continuation of the legendary Homestake system, does Dakota Gold DC suddenly become an irresistible acquisition target for a major miner?
It's a very compelling scenario.
I mean, think about the macro environment. You have major players like Barrick or Newmont watching their global reserves deplete, and they are desperate for safe Tier 1 jurisdictions.
Right.
If DC proves out a fully funded, permitted on private land, dual asset system right in the middle of the United States, I mean, a major miner might just decide it was significantly cheaper to buy the entire company at a premium today than to let DC build it themselves.
It is a very real, mathematically sound possibility in the current M&A environment. If the JB Gold Zone at Maitland proves out at scale, Dakota Gold DC immediately transitions from being a single asset developer navigating the Valley of Death into holding a district-scale production pipeline.
Our listeners, what's your take on the future of Dakota Gold DC? Are you bullish, bearish, or sitting on the fence? Let us know in the comments. See you next time on the Bite-Size Brief.